Hello, students and teachers. One of the things that we have not talked about yet, but I think is important for you to understand from a investing, a trading, a technical trading standpoint of markets is tomorrow is the Federal Open Market Committee meeting, the Fed, in which they're going to announce their decision on interest rates. Now, the interest rate is the money that the banks pay to borrow money, and that's the rate, and then they charge what they're going to charge over that. But the point here is that the whole market has become very much around what the Fed does or does not do. We become totally Fed dependent on their information. And when you look at this information, what you're looking to find out is if the Fed is going to indeed raise rates, or if they're going to do nothing, or maybe they're going to have some kind of quantitative easing program. There's a whole bunch of variations of things they can do or cannot do. But what you want to take a look at here, and some of the things to watch to kind of give you an idea of what the market is thinking, because one of the things we've talked about is market expectation. So what is the market expecting? Well, if you look at the equity market, which is the stocks, the S&P 500, they are pricing in that the Fed is going to do nothing and continue on the free money train. However, if you look around at some of the other things that are affected by this, which there's a lot of things that are affected by this, look at the US dollar. The US dollar has been a little bit weaker, indicating that, okay, the Fed is going to do nothing, which that would make sense. Low interest rates, dollar stays lower. But look at the gold market. Gold is all of a sudden selling off very hard. That is telling us that if the Fed raises, that would make the dollar stronger, which would make gold weaker, which means that that's a potential possibility. Now, there isn't really likelihood of that, but the different markets will give you different messages, and what you're looking for is to make your decision based on a chart, on a technical pattern, based on all these outside factors. The last thing you would look at is the Treasury Bonds, which when the Treasury Bonds themselves go lower, that means interest rates are going higher. When they go higher, that means rates are going lower. Right now, bills, Treasury bonds have been going lower, indicating interest rates are going higher, indicating the Fed may be indeed going to pull a surprise tomorrow. But overall, these are factors that you look into and you weigh in your decision based on the footprint you also see in the market. So that's our lesson for today. This is Todd Bubba Horwitz from highschoolinvesting.com, coming to you from the floor of the CME Group in Chicago.